fourth part of the problem says, okay, now we're at the end of the first year. We got to create a set of financial statements, income statement, balance sheet, cash flows, retained earnings, so on and so forth. And so let's take a look at the bonds and make sure that they're accurately reflected in the in the balance sheet, what the bond payable says it is, and that our income statement has the appropriate amount of interest expense. If we make no adjusting entry on December 31st, our income statement is the profit is overstated, and the balance sheet, the bonds payable could be understated or overstated depending on the group of the bonds. So, and all of this, and the adjusting entry depends on the nature of when the payments are actually called for in the contract. All right, so just think about this logically. We have these bonds, we agreed, we shook hands, we signed the contract on January 1st of 2016, and now one whole year has gone by. It's December 31st. One whole year. We borrowed money from an investor for one whole year. We borrowed money for 1 year, but we've only made one interest payment. That was on July 1st. And we correctly accounted for that payment when we went ahead and we recorded interest expense for each of the three groupings down here. We just did that, right? But if we stop here and we don't, because the next payment doesn't happen until January 1st, so we're not going to record another payment. If you don't do anything at this point, what you're telling a user of financial statement is, look, I've only got interest expense of 6 months, one payment on my income statement, and that is completely false, right? We borrowed the money for 1 year. If we borrow the money for 1 year, we should have 1 year's worth of interest expense. Currently, we only have 6 months worth of interest expense for each group. So the interest expense is understated. And if an expense is understated, it should be bigger, right? Profit is overstated. So we're misleading the investors. We need to get the right amount of interest expense into the right accounting period, regardless of when the payment actually occurs. So the next 6-month period, we're going to make the payment on January 1st of the following year of 2017, but we need to get the interest expense into the right year. So for the Group 1 bonds, here's what it's going to look like. I'll just do this right underneath our previous entry, which was to record the first payment. Okay, remember, we are not going to record a payment here. We're not going to pay cash, but we do need to get interest expense into the income statement. And it's for 6 months, right? 6 months have passed. July, August, September, October, November, December. I'm counting on my fingers here. That's 6 months. So all 6 months, another 50 grand, right? Because the next payment says you're going to have $50,000 more of interest expense. Okay, debits have to equal credits. We're not going to pay it yet, so we don't credit cash. We got to credit a promise. Interest payable. And we just simply record the interest accrual. We accrue for interest for Group 1 bonds payable. That's it. So now we have 1 full year's worth of interest in the income statement. That's correct. The balance sheet's still going to show a bond payable of $1 million. We're good with the Group 1 bonds. Group 2 bonds, though, again, we only have 1 payment's worth of interest, 6 months. So we've got to make this 2016 adjusting journal entry. Again, we're trying to get more interest expense into the income statement. Well, how much interest expense? Last one was easy. It didn't vary for the Group 1 bonds. Group 2 bonds vary, right? Well, this is why having the amortization table is helpful. This is my next interest payment. This is the amount of interest expense that's going to be associated with that payment. So this is the amount of interest expense that I get into the income statement in the current accounting period, which is 2016. That's how much interest expense I'm going to have. But I'm not going to pay that much in cash. Actually, I'm promising I'm going to pay him $60,000. If I don't put this on my balance sheet as a payable, my liabilities are understated, and that's not a good thing, right? So we're going to have to put my interest payable. The contract says I'll pay you 60 grand. We got this difference, right? What do we do with the difference? Well, what do we do with it before? It simply goes to reducing the premium, and that's the amount carried from this portion of the table, 64.46. This reduces the premium on the bonds payable. That's how we accrue for interest for the Group 2 bonds. So the description here, accrue for interest on Group 2 bonds, 12/31/16. Okay, that's the Group 2 bonds. Group 3 bonds are somewhat similar. Remember, we only have 6 months worth of interest. We need to get 6 more months worth of interest because we borrowed the money for the entire year. So we get interest expense, you can spell. And the interest expense amount, again, comes from the amortization table. It's the second interest payment period, 46,445. Again, we're not paying cash. We'll give them a promise that they can come back the very next day and collect the cash. And this time they're allowed to collect only 40,000. So the difference goes to the discount on bonds payable. And this is to accrue for Group 3 bonds, 1231. There, now we can look an auditor in the eye and an investor or creditor in the eye and say, look, these financial statements are accurate in regards to the bonds. We've got the right interest expense, we've got the right current liabilities, and now actually what you would see is the bond, the long-term liability changes as well. The carrying value changed, it went up, right? So there's a little bit more of a long-term liability, and in terms of the Group 2 bonds, it went down. So that's the accruing for interest that happens at the end of the year.